So I'm going to start a bit light. As we all know, this space started with the early evolution of distributed ledger technology, which was built on proof of work, which is what Bitcoin was created on. We then evolved to to proof of stake, and then delegated proof of stake, because people realized that the energy consumption was too high. So the first participant was Peercoin. And then there was the creation of smart contracts, so Ethereum, who is still, in fact, a market leader in this space. And then there were many clones of this Ethereum virtual machine. So, for example, Avalanche and the Binance Smart Chain are some examples. And we have now evolved to a truly sophisticated space where we have networks such as Algorand and Binance Smart Chain, who basically solved some of the problems that Ethereum was facing. So, for example, scalability and transaction speed. And basically, some of these networks are working on a multi-chain, multi-party network protocols by sharding, which is sort of emulating the space that Swift works on. So basically, different transactions settled on different networks, which is, of course, a long way ahead from where we started. If we had to look at the evolution of cryptocurrencies, as everyone knows, we started with Bitcoin. Then we started with the first clone, Litecoin. Then we moved to the first meme coin, Dogecoin. Then we saw the ICO boom and the rise of shitcoins. And then, unfortunately, we had a 2-year, very long crypto winter. And after that, fortunately, we saw the rise of stablecoins, which I believe filled many gaps in the DeFi space and helped the movement of the DeFi space for reasons I will talk about soon. So this is the current state of play we're in, DeFi. So as you can see, there are many, many players. If you look at DeFi before 2020, there was mainly exchanges, wallet providers, some other market participants like brokers or managers, but not many borrowing services, lending services, automated market makers. So very advanced space. So, for example, we have certain lending platforms like Aave and borrowing platforms like Aave, Compound, Nexo, who basically are offering lending and borrowing services via crypto. So, for example, Compound alone at the moment has about 18 billion assets earning interest, which, of course, is quite a significant amount. Okay. And of course, why is this space attractive? Why is it attracting so many new participants and users to the space? This, of course, because this space offers a certain financial freedom. So anyone can buy or convert or digitize their euro, their dollar, buy crypto, buy stable coins. Then they can lend their stable coins and earn quite a high yield, so between 8 to 12% from what we're seeing on the platforms. They can also borrow crypto, so they can use their crypto as collateral. So, and then depending on the type of crypto they have, there'll be a risk analysis, and the platform will tell you how much you can borrow. And there are also very advanced liquidation protocols, which will close your position when your collateral starts to diminish. So very advanced platforms and protocols. So of course, this is very attractive for many, mainly due to the interest-bearing aspect. So as many know, in traditional financial markets right now, if you hold your money in a normal account, you will either have 0 interest or negative interest. If you hold your crypto in one of these platforms, one of these interest-bearing accounts, you can have some passive income. So this is why a lot of mainly the younger generation are figuring this out and are transitioning to that space. However, there are, of course, still a number of significant risks, many hacks taking place, as you're all aware, I'm sure. So, for example, the latest hack was just a few days ago on the Compound network, where about 90 million comp, which is the native token of Compound, got given back to users. Obviously, there was a glitch in the system. This wasn't intentional. And then it was very hard to fix this glitch because of the DAO protocol, the DAO governance model they had. So it took a few days to actually rectify this problem, because it took a few days to actually implement the decisions being executed. There are also some other big recent hacks, such as Solana, where 600 million in assets got hacked, but then got returned. Also Coinbase, which is one of the biggest exchanges, got hacked. And they smartly used some good tactics to retrieve the funds, which were using bounties or white hat hackers, and they retrieved many of the funds. So that was interesting to see. So of course, this space still needs to develop further, and perhaps we should see more security dApps being created in this space. I know there's a very good recent project platform called Lossless, which is helping very big funds retrieve some assets which are getting stolen. Among the many market players, we are seeing also STO exchanges popping up. Many of these exchanges are still very small in terms of listing and liquidity, and this, I believe, is because stable coins had not yet existed properly, or there wasn't such a big presence and domination in terms of stable coins in the market. So I think due to stable coins, we will see STO exchanges develop much, much further. So as you can see behind me, there's a picture of David versus Goliath. David is representing stable coins, and Goliath is representing central bank digital currencies. This is a very, very, very hot topic right now. We are feeling tensions rise between policymakers and between issuers. Why is this? So basically, before the rise of stable coins, although we had many popular cryptocurrencies such as Bitcoin and Ether, they did not satisfy the conditions and features that money needs to have in order to be called and used as money. So basically, money needs to have three main characteristics, which are it has to be a medium of exchange, be a unit of account, and have a stable store of value. Now, before stable coins, these cryptocurrencies lacked the third one, stable store of value. So the rise of stable coins, so I think the current market cap is at about 113 billion. And in the first quarter alone of this year, we saw 1.3 trillion transactions take place, is on the rise. So this, coupled with DM, which is ex-Libra Facebook coin, is obviously really worrying policymakers. I will tell you why in a minute. On the other side of the spectrum, we have central bank digital coins, which of course are also being sped up in terms of production. And for those of you who perhaps are not very familiar, central bank digital coins are money as we know it, issued by the central bank, and still subject and exposed to risks such as inflation, such as interest rates, and are still subject by the normal monetary policy as we know it today. And also for those of you who perhaps aren't very familiar about what a stable coin is. A stable coin is a coin, basically, which derives its stability from an underlying asset. So this could be fiat currencies, this could be commodities, this could be a mix of both. And there are many popular ones, mostly US dollar-backed, so Tether, USDC, but also other ones which are pegged to fiat, but also backed by crypto as collateral like DAI. So there's many different business models. Just some are experiencing more rapid growth than others. I'm just looking at my notes, not to forget any value points. I hope you don't mind. Okay, and how are regulators responding to the rise of stablecoins and the fear and the threat that their bread and butter, which is the supply of money, might be impacted? They, of course, see the benefits that stablecoins present on a global cross-border level, but they also are very wary of some of the risks which they could be exposed to in terms of their current traditional financial market infrastructure. So basically, stablecoin arrangements consist mainly of three functions. One is the payments function, one is an asset management function, and one is a user interface function. So user interface is wallet, payments, everyone knows what payments are. And in terms of asset management, the ECB, so the European Central Bank, has stated that depending on the asset management arrangements, so in terms of collateral and reserves, stablecoins could very well qualify as either e-money, either as an investment fund or a money market fund, or certain platforms could qualify as banks. So the ECB and the BIS have been releasing new information and opinions about this space for the past few weeks and months now. And it's getting heavier and heavier and more narrower and narrower. So for example, if a stable coin is redeemed at par and is backed by a fiat currency and gives a promise of a claim over the issuer, this could qualify as e-money and be subject to e-money regulations. If a stablecoin arrangement, for example, gives a claim on the assets or on the issuer, is invested in non-zero financial assets, and also gives back a pro rata interest based on their holdings, this could qualify as a fund or as a money market fund. And also, if we have platforms who are dealing in giving credit and deposit taking, these could qualify as banks, says the ECB. However, of course, this very, very much depends on the business model of the stablecoin arrangement. So, for example, if you have a stablecoin which is fully backed and collateralized by fiat currencies, but does not give a promise or of a claim on the issuer, then this will fall into the gaps of regulation. So many should really look at the arrangements of stablecoins, especially if they are dealing in very, very large transactions on a cross-global trade level. So the European Central Bank is mainly concerned because if there is a stablecoin, which is very, very widely adopted, so let's say if DM, once it's launched, is widely adopted, and it could very well be, because there are 2.4 billion users, and 10% are in the European Union, so that's about 240 million users in the Eurozone. If it is widely adopted, and there is a stablecoin run, of course, this means that all the users will want to redeem their stablecoins, which means that all the underlying assets which the basket is investing in will need to be liquidated. So, of course, in the grander scheme of things, this means that traditional markets and economies could experience an overfill and, of course, be very negatively affected. Because most of these big stablecoin, fiat-backed stablecoins are mainly investing in liquid cash, but also in government bonds, in debt, papers, in commercial debt. So basically, if there had to be a stablecoin run, and most of these stablecoin arrangements are invested in government bonds and cash, obviously the traditional market is going to feel massive instability. So policymakers are slowly realizing this and are taking a proactive approach. On this point, in terms of a proactive approach, I think I'd like to mention there's a directive called MiCA. Perhaps the lawyers in the room are familiar with what this directive is. Well, it's not a directive yet, it's still in consultation. But basically, the European Union has passed a consultation paper trying to govern crypto assets. And basically, a couple of things could negatively impact stablecoins if persons wish to issue stablecoins in the Eurozone. So, for example, MiCA states that firstly, it categorizes and defines what stablecoins are. So it has to be either fiat-backed, redeemable, and claimed on the issuer, or it has to be asset-referenced, meaning that the basket of currencies will be composed of commodities and fiat, or else if it's a financial instrument, it will be a security token. And basically, MiCA says if there is an issuer who's looking for authorization to issue their stablecoin in Europe, they cannot be interest-bearing coins. This, of course, is because this will be more attractive to the market to hold your fiat in a stablecoin and then receive interest, which could impact the banks, since their main business is lending. So if there are less deposit holdings and takings at the bank because of stable coins, this could also impact that side of the market. So if MiCA comes into force, which they are projecting to pass in about 3 or 4 years' time, this means that all the member states of the European Union will need to implement and transpose this directive into their, the last slide, into their legislation. So, is it all doom and gloom? I have to be the devil's advocate over here. So what does the future hold? So many, probably because they are used to a culture of compliance, feel that we need regulation to protect investors and validate the markets. However, in reality, can the markets self-regulate themselves? So I was reading a very, very interesting interview of a person called Larry White. He's a very famous economist in America. And he basically said that there was a time when places and periods experienced free open banking or very lightly regulated banking. So in the 1700s, 1800s, and early 1900s, there were some countries and jurisdictions, like some states in the US, Canada, Switzerland, Chile, Scotland, which experienced free banking. So private institutions acting as banks, giving banknotes which were redeemable by gold or by silver. And he said that, in fact, these models worked very well. They didn't need any interception from the government. He said because, one, they were not exposed to inflation, there was no monopoly of money, and they gave very, very efficient payment services. So one asks, why was there a creation of central banks? Why are we in the state that we are now? Basically, governments throughout history have realized if there was a sole issuer of money, a central bank, they can easily tap into cheap credit, and also they can easily tap into government bailouts to pay government debt when it is needed. So in reality, history has chosen to accommodate firm fiscal institutions instead of money users, from Larry White's synopsis. So, of course, where are we now? We have a lot of positive updates in terms of adoption. We have Visa and MasterCard and PayPal who have adopted and facilitate crypto transactions. We have extremist countries like El Salvador who decided to make Bitcoin their national currency. We have really good e-commerce companies like Coin Payments, who I think have aided about 19,000 businesses worldwide receive or convert or store crypto transactions. And of course, on the other side of the spectrum, we have the ECB, the Federal Reserve, SWIFT, China, another extremist country, has banned crypto. So in conclusion, will you think it will be a case of first they ignore you, then they laugh at you, then they fight you, then you win? Thank you very much. I really hope that you enjoyed my presentation and that I gave you some value today. I didn't introduce myself in the beginning, so I will do so very quickly now. My name is Justine Scerri Herrera. I'm the partner of MK Fintech Partners, which forms part of a large top-tier international group called Michael Cipriano. And I was also on the task force for digital economy under the government of Malta for the last 2 years. If anyone wishes to contact me, this is my email address, and I'm also on LinkedIn. And I'll be floating around for the next couple of days. Thank you.